Hello and welcome to an FX Times daily video market recap. I'm CMS Forex market analyst Nick Nassad. Today's Friday, November 13, 2009. We start today's recap with a look at some fundamental releases from around the world. The Eurozone released its third quarter preliminary data for GDP, which saw the economy exit its recession as the economy grew 0.4% in quarterly terms, though it was a figure that was slightly smaller than forecast. On the year, GDP was down 4.1% compared to the second quarter's 4.8%. The rise was propelled by higher exports from Germany and France, as well as the shot in the arm the economy received from government stimulus measures and loose monetary policy from the ECB. Still, there's high unemployment in the economy, which can cut into consumer spending, and economists now turn their eye onto what happens as the stimulative fiscal and monetary policies begin to be withdrawn from the economy. In the U.S., the trade deficit widened in September to show a trade gap of $36.5 billion, a figure that was worse than expected. It reflected higher imports, which grew by 5.8%, while exports grew 2.9%. So even though there was more trade in the month, imports overpowered exports here. The increase in exports was led by sales of civilian aircraft, industrial machines, and petroleum products, and were also boosted by a weak greenback and a pickup in growth in both Asia and Europe. Imports, meanwhile, were mainly up as a result of higher oil prices and higher volumes of oil imported, while there was also a pickup in demand for foreign cars, so that was mainly companies restocking following the Cash for Clunkers program. And a third release that we're going to look at is the UMISH consumer sentiment for the mid-month of November, which declined rather sharply and surprised forecasts, falling to 66.0 from October's 70.6. The consumers are more gloomier as a result of higher unemployment, and low consumer confidence could impact consumer spending heading into the holiday season. We see from our chart on the right that consumer confidence had fallen dramatically during the most of 07 and 08, and we bottomed out around March and April of this year. We saw consumer sentiment rising again, but after a positive trend, we've seen now 2 months of declines in the index. Despite the weaker trade and consumer confidence reports from the US stocks were up today, clawing back some of their gains from yesterday, and that helped risk appetite in higher yielding pairs like the euro. We saw the euro gain overnight and then dip in the wake of its GDP release and the US consumer confidence, but it bounced up off a support line connecting lows from November 5th and 8th and from yesterday, and we had a rather strong bounce until we reached the 1.4940 area here. That puts us back within sort of the range we've seen the last 6 sessions or so, and we're going to see what will come about in next week's trading. We're going to end the week a little higher than we started, and if we plot a Fibonacci retracement of our rise in this pair from November 3rd to November 11th, we see that today's support also came around the 50% area, so traders managed to retrace this rally by 50%, and now we've seen a pretty strong bounce up afterward. Where the pair stalled today also conforms to a downward sloping resistance trend line if we connect our highs from Wednesday and Thursday, and we see a very nice test there and then a move back down. So even though we've had a week where we didn't move far away from our established ranges, all indications are pointing that the Fed will keep their interest rates low for a prolonged time, which should help to boost risk appetite and carry trade, with the dollar being used as the main funding currency. In a look at the euro-yen pair, we see the euro sliding all the way down to the 132.85 level today, and it did not manage to win back all of its losses. We had a short-term break of support here around 134, and also we had another break of another support level if we connect these lows from some of the lows from last week and our lows this week. So here we're sort of ignoring this move lower in the beginning of November, but if we also draw a line of resistance, we see that we managed to kind of break out of this wedge pattern that had been set up where the pair had been consolidating for most of November. So now we may be looking at something more along the lines of a rectangle if we turn our upward sloping line of support more to a horizontal line. And here is today's support and how it matches up to what we had here. The US dollar Japanese yen pair, meanwhile, also fell in favor of the yen, following its rally yesterday on Greenback strength. We sort of tested this downward sloping resistance level, and we fell after we were unable to penetrate it. We also had this level of resistance that had turned to support shortly during part of today's trading, but then it too was cracked, and we even fell below this support here around the 89.60 area. So despite some better stocks in US trading, overnight trading did see the yen gaining rather substantially against the euro and dollar. The pound, meanwhile, also rallied against the greenback as it found support around 1.6515 in yesterday's trading following its slide on Wednesday. We managed to pair a good chunk of those losses in today's trading, and if we set up a Fibonacci retracement of the pair, we see that we've sort of been bouncing around this 50% and 61.8% area, though not perfectly, as we did peak above 61.8% in part of today's trading, where our resistance came at 1.67. The Australian dollar US dollar pair, which we saw tumble yesterday from its 15-month high around 0.9365, managed to regain most of those gains in a very strong move today. This support around 0.9220, where we started the week, held very nicely, and that was apparently a good opportunity for traders that are bullish on this pair to buy this pair. The fundamentals right now favor the Aussie, as it's one of the few central banks that has begun tightening its monetary policy, with the Reserve Bank of Australia raising interest rates twice already, and with the dollar, with all expectations showing the Fed holding its ultra-low interest rates, the Australian dollar seems to be set to gain even more against the greenback. And a look at the cousin of the Australian dollar US dollar pair, the New Zealand dollar US dollar, we saw very similar price action, with the Kiwi being able to pair all of its losses from yesterday's session. We ran up against resistance from this week's trading around 0.7450, and that's where the pair looks to finish this week's trading. Zooming this pair to show a little bit more past history, we see that we had a pretty nice bounce off this old level of resistance that has now turned to support right at the 0.7315 level. So you could see that here. Last week it acted as resistance, and then now we have tested it as support. So this is a very sort of classic sign of a retest of support turning to resistance. So we'll see next week whether we see a move above 0.75 in this pair, 0.7450. Next week we'll have a bit more in the way of US fundamental releases, as we're going to see data on retail sales, producer and consumer prices, industrial production, housing starts, and two regional manufacturing surveys, the Empire Manufacturing Index and the Philly Fed Index. Around the world, Sunday we're going to get the third quarter preliminary GDP data from Japan, UK retail sales, and its Monetary Policy Committee meeting minutes. Canada will also post its consumer prices. The UK on Thursday will post retail sales, and also on Thursday Japan will have its Bank of Japan interest rate meeting. And that'll do it for this week's coverage of the Forex market. Please come see more analysis and videos at our site fxtimes.com. I want to thank you for watching, and have a great weekend.